Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone, and welcome back to our weekly podcast, Through the Noise. My name is Hannah, Portfolio Strategist with the Standard Chartered CIO office, and I'll be your host for today. So joining me today is Manpreet Gill, our Chief Investment Officer for EMEA, to help unpack market events and talk about positioning and where opportunities might lie next. So thanks, Manpreet, for joining us again. We've just released our latest global market outlook, and it does seem to have quite an emphasis on yields. So I think US bond yields, that has remained quite a key concern for investors. But we're also seeing some signs of cooling inflation and a softer labor market that could suggest the yield pressures may be approaching a ceiling. So what really has been driving the recent rise in long-dated US Treasury yields, and what are the implications from an inflation outlook?
Hi, Hannah. Thanks so much for having me on. You're right that in the US, we've seen the 30-year government bond yield rise by around 40 to 50 basis points this year, which in turn, of course, triggered a response from the US Treasury as it seeks to signal its desire to contain the rise. Now, inflation concerns remain one of the more commonly cited drivers behind the rise in bond yields. However, with the rise being disproportionately concentrated in longer maturity yields, we'd argue that at least some of the concerns are related to the continued rise in US national debt. There's also several technical factors that have likely contributed to the rise. So that includes the relative absence of some key sovereign buyers. And of course, we've seen significant hyperscaler bond issuance in the investment grade corporate bond market. Now, just on the point, on your question on inflation specifically, I would say that we're relatively less concerned about the inflation risk and indeed believe there's room for market worries to actually recede a bit. The recent cooling of U.S. inflation data and what was a lackluster job market data set point to less rather than more inflation risks ahead. Oil prices, of course, are a risk, but we do expect them to remain in a range around $90 per barrel for now, assuming there's no significant new escalation in the Middle East conflict. So when you pull all of that together, it suggests inflation and therefore bond yields are more likely to move lower rather than higher from here. And that, of course, is consistent with our continued view and expectation of a soft landing for the US economy.
Thanks, Manpreet. And I guess, what does this mean for a bond portfolio positioning then?
So I think when you think about our expectation of softening bond yields, that should be most pronounced in the relatively shorter duration bonds, because the lack of renewed inflation fears should help ease concerns about Fed rate hikes. However, that impact is likely to be increasingly damped as you go further out, longer on the maturity curve, particularly beyond 10 years, because that's where easing Fed rate hike concerns balance against longer term concerns about US debt levels. So from a bond portfolio positioning perspective, that's why we continue to see the 3 to 5 year duration as offering the most attractive risk reward. But admittedly, from today's levels, we would consider selectively adding to longer maturities should the 10-year yield spike, temporarily above 4.75%. Now, taking a slightly more granular view here, within bonds, we do maintain our relative preference for corporate and emerging market bonds over, G3 government bonds. Credit spread valuations no doubt remain elevated, but we believe credit fundamentals continue to justify these levels. Our overweight remains focused on emerging market US dollar government bonds, and that's due to fiscal fundamentals. But we'd argue that most corporate and EM bonds remain attractive sources of yield. Only possible exception, perhaps more from a short-term perspective, is US investment-grade bonds because they face excess supply pressures, in that very short-term horizon from elevated hyperscaler debt supply.
I guess a natural question is, how then is the team assessing the impact of these current yield levels on equities?
Well, easing short maturity US bond yields should actually be supportive for equities, as long as long-term yields, of course, remain capped, because that would mean markets can continue going back to focusing on what are very strong earnings growth. Additionally, the actual movement of pricing out of Fed rate hike expectations itself would be equally supportive of equities. So overall, at a broad level, that's really why we remain overweight on equities at a global level.
So what about opportunities if we take a look at sectoral or even from a regional lens then?
So if we look at it from a sector perspective, right? So financials is one sector that we believe is an attractive route to broadening exposure, because for us, financial, of course, are preferred across major regions, across the US, Euro area, and Japan equities. They're usually a direct beneficiary of a steeper yield curve, or in other words, a widening gap between long and short maturity bonds. And that impact, of course, happens via usually expanding net interest margins. We also like financials as a sector for the diversification they offer from what could otherwise be excessive concentration in the AI theme alone. Now, that being said, and notwithstanding, of course, our preference for broadening exposure, we do see positive momentum in the technology and AI sectors and expect that to continue. Or resume rather after what has been 2 months of relative underperformance, to value-style sectors. Now, concerns with the magnitude of capex are likely to resurface from time to time, but we believe improving AI monetization indicators point to continued sector outperformance. That sectors, of course, but from a regional perspective, the combination of our bond yield and our sector views ultimately culminates in and supports indeed our overweight views on the US and Asia ex Japan equity markets, as well as our core holding views on Japan and Euro area equity markets. The AI theme benefits US and Asian equities more directly, but our financial sector preference should also help drive performance across Japan and Euro area equity markets, particularly if their central banks raise rates further, the ECB and the Bank of Japan, which is something we expect.
Thanks, Manpreet. I guess if we just shift a little bit into the FX space, what are your thoughts on the US dollar or maybe the current outlook for the greenback?
Well, we do see some downside risks. So, on a 3-month horizon, we have reduced our forecast for the US dollar index, to 98 from what was 101.5 earlier. And this, of course, links to the US Treasury's decision to double liquidity support buybacks in the 10 to 30-year government bond debt from what was $2 billion to $4 billion per operation through early November. We see that action essentially aimed at capping long-term bond yields as a new near-term headwind for the US dollar. Now, the initial decline in the long yield and the US dollar suggests that higher government bond yields may provide less reliable support for the US dollar when the worries are driven more by fiscal concerns and the term premium rather than stronger economic growth or core real yields. And if you look at the job market, for example, non-farm payrolls were actually fell by 23,000. And wage growth, of course, slowed to 3.2%. So, all of that pointing to a less one-sided US growth story from a growth perspective. Our view on a 12-month horizon, of course, is similar. We also expect US dollar index to decline gradually towards 96. Narrowing global interest rate divergence, persistent US fiscal and external balances, all of these weigh on the medium-term US dollar outlook. Now, softer US labor and inflation momentum do support our view that the Fed can remain on hold. But you have obviously our expectation that the Bank of Japan has room for greater normalization. Australia's RBA and Europe's ECB, of course, also holding that hawkish bias, and all of that together should continue to chip away at the US dollar's relative rate advantage. So, we just think that all of this comes together in supporting a 12-month horizon for a gradual decline in the US dollar.
How about any more, notable changes in the portfolio positioning given this latest outlook that we have?
Well, I would highlight gold here. We actually expect gold to be one of the beneficiaries of the dollar weakness we just discussed, and we've taken the opportunity this month to reinstate our overweight on gold. The gold price outlook has notably improved alongside that sharp pullback in the US dollar, and arguably what's a technical break higher in gold prices themselves. Long term, emerging market central bank demand also continues to be a key source of support for an uptrend in gold. In the near term, that still high inverse correlation with the US dollar is indeed proving to be a positive catalyst. So from a price target perspective, we have also, besides, upgrading the asset class to an overweight, we've also raised our 3 and 12-month price targets to $4,750 and $5,000 respectively.
Thank you, Manpreet, for your thoughts and for sharing with us all the changes in the global outlook that we're releasing this week. So I think in today's session, we've discussed quite a bit on our take on the US bond yields, which we do expect to be increasingly kept. So this bond yield outlook as well as the momentum in the AI theme, they do seem quite supportive of our overweight views on the US and AXJ equities. And gold also seems to have gotten back its shine, where we've reinstated the overweight stance. So that does bring us to the end of today's episode of Through the Noise. So thank you again, Manpreet, for joining us, and thank you to all our listeners. We do look forward to having you join us again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.